Is this thing on? Okay, guys, you are finally here. So let me show you about the courses I'm gonna launch in the next year. So position swing trading, I just released it in October, so that's ready to go. That's the basic foundation of all my other courses. One thing about me is I have a different methodology of trading and investing. So if you have taken a course elsewhere, whether it's Online Trading Academy or whatever, I have one question to ask you. Are you making money? Is your tax return showing a positive number at the end of the year? If yes, which I don't think so, but if yes, my second question is it enough for you to become a professional, fully professional trader where you're drawing down money to actually live off of that gain? If so, then my channel is not for you. So, but if you're struggling as a trader and you've learned from different people and things are not working out for you, these courses are perfect for you. If you've never touched the market, you don't know nothing about stocks, it might be a little bit challenging, but you might want to keep my courses as like a Bible reference as you get better and better and the terminology starts to make sense, because there's a lot of information if you don't know nothing about stocks and you don't know nothing about finance. But I try to make my courses as simple as I could, because before I used to teach portfolio management and a lot of the people would have headaches and it was very complex for them, especially if math is not your strong suit. So I try to make it as simple as I can and dumb it down in layman's terms. All you need is basic algebra and some common sense and you can make it happen. Let's talk about social media. Well, first off, let me show you our office, our company. I'm shooting this from our office and not my mother's basement. Okay, if you have a chance, make an appointment with me. Come see us in Las Vegas. The office, we're trying to expand in LA as well, eventually once things pick up. But yeah, as I said in my prior video, there's a lot we're doing with Avalanche Partners. And if you take at least 2 of the courses, then you'll have an opportunity to buy discounted shares in my common stock, in my company's common stock. If you take all the courses, then you'll have opportunity to buy preferred stock at discounted prices. So I want to bring the right team of people into my company, as I have major plans in the future. Okay, so let's continue, because there's a lot of information to cover. So please tell your kids to get out of the room. Make sure your cell phone's off, turn it off, bring a calculator, have something to write with, and if you miss something, make sure you rewind and rewatch it, because I'm a very meticulous person. When I'm watching a movie and my girlfriend starts talking, I pause it, I listen to her, and I'm like, "Are you done?" Okay, and then I, resume. So I don't like it when I might miss something extremely important when she's talking, so it's very important you don't miss anything, because something I say now might be a part of a different course later on, okay? So here we go. As far as social media, the most important social media channels that you should follow me on, Facebook should be priority, because on Facebook, I allow you to see all of my trades, all my investments, all my past investments. You can go and check them out. So if you can time them, you'll make money. But I try to post as much as I can. Okay, so I don't never have to charge you for that like other people do. So that's, go ahead and use it and follow me if you want. One thing is I cannot legally give advice, buy and sell recommendations, so don't ask me that. Okay, I'm just telling you what I'm doing. So if you want to copy what I'm doing, that's up to you. Also, do not hold me as a in liability. Basically, if let's say you lose money. Okay, so I don't post as I take a loss. So sometimes I might say something and then I might take a loss on it, and I might move on to another company. But you'll know my position sizes most of the time. YouTube channel, I'm rolling that out. YouTube, I'm going to be talking about different companies, basically financially dissecting them, just like Jim Cramer, pretty much. So YouTube is very important as well. And then Instagram, if you want to take a look at my personal life and see my goofy side, then go ahead and follow me on Instagram. And then I'm also on LinkedIn. I like to poke fun at the corporate cookie cutters who cannot talk back because they're worried about human resources taking an adverse action against them. I like to be free because I'm at a point in my life I can say whatever I want. And it's great. I don't have to worry about anything. And then Snapchat, I'm barely getting into Snapchat, but I still don't get the point. Besides the filters, I don't know. So Snapchat, once in a while I might use it. And then Twitter, instead of Twitter, I used to use StockTwits, stocktwits.com. If you're an active trader, you have to be on StockTwits because it has a lot of cool things like the mapping feature. It tells you where the hot sectors are, what's selling off, what's being bought. So I have an account on StockTwits. I have a lot of followers, a couple of hundred followers there. So there you go. I don't use WhatsApp, maybe once a year, and then Skype. I used to use it, not anymore as much. So there you have it. Facebook, YouTube, Instagram, LinkedIn. Okay, follow me there. And it's just Stocks Bootcamp. Let's make it simple. Besides, with the exception of LinkedIn, you have to put my full name, which is Edgar Ambertumian, and then you can follow me there. Okay, so the first course, Position Swing Value Trading course. I say value trading because, again, my courses are the first courses ever to include financial analysis. I don't trade junk. I don't just trade anything. And most day traders, they just look at a symbol and they just look at the technical patterns and they trade. I don't do that. I make sure that whatever I get in, it's a company that the financial institutions or the hedge funds are going to accumulate. If they don't accumulate, then of course I'm going to be sitting there holding a bag, basically an unrealized loss that I cannot recover from because I don't know how long it's going to take until the stock recovers. So I want to make sure that I'm in valued companies, preferably over 50 billion in market cap. Sometimes my speculative side, I'll go down as much as 10 billion, 5 billion. But the days where I'm trading junk and penny stocks, those days are over. I'll talk a little bit about that later. So spring of next year, I'm going to launch Momentum Day Trading and Scalping course. As I said, that course is a separate course on its own, has its own set of rules and regulations, and some of them are actually contrary to the position trading. So things like averaging down is a lot of times is useless in day trading. You have to cut your losses early, and taking losses is part of the game, as I mentioned. So that's going to be a very tough course to create because I'm just going to have a lot of different scenarios of me trading live and what I would do in certain situations. I think that's the best way to teach, instead of just me droning on an hour about just a technical analysis pattern. You're going to learn all the technical analysis patterns in Module 2 in this course. So, as I said, there's a lot of manipulation, so day trading is not for everybody. And we'll get back to that. Options course, definitely you should take the options and the hedging course if you're going to take this course. Okay, if you take the position value trading course, you should definitely take the options and hedging because they're going to amplify your gains, and you're not going to reach triple-digit yearly gains if you don't take these courses. It's almost impossible to do it with just stocks, okay, on consistent basis. And then once you want to take your money management to the next level, then you can take the portfolio management course, which I'm going to finish next year by fall of 2020. Okay. A little bit about my favorite professor, Ronald Sweet, in University of Texas, San Antonio, where I finished school. He was the only professor who had an impact on me, and it was one of the toughest classes I ever taken. Our final was to do a 30-page thesis on a company that we chose and thoroughly do a discount cash flow analysis and a financial analysis. So I barely got a B, but I used a lot of that information to write an article on Seeking Alpha that won an Editor's Choice Award and got over 200,000 views. So you should Google that article called An In-Depth Look at Chevron's Profitability, and my article should pop up, and you can follow me on Seeking Alpha also. This man was a genius, and the $40,000 in student loans that I accumulated finishing school was worth it just for that one class. And within the first 10 minutes on the first day, I'd say 20% of the class was whispering and already thinking of dropping the course after reading the syllabus because they were afraid and they wanted to take an easier class. So they were already looking to switch, and I was like, no, I want to learn. I want to stay in this class, and I'm glad I did. So when you come into this boot camp, I'm going to be strict because it's a boot camp. Okay, I know you don't see it, but there's a scar on there's a little scar on my chin, and this was because when I was in Armenia and I was talking during class, the teacher threw a set of keys and bust my chin open. Okay, because I was talking to a girl, I was trying to hit on a girl, and I'll never forget that day, and the education system back in the day in Armenia and Russia and Kazakhstan, where I went to school a little bit for a couple of years, it was way tougher than here. Whereas when I was graduated UTSA, we had an auditorium full of 300-400 people, and I'd say 70% of it was on Facebook and Instagram, not even paying attention to the professor. So I'm very strict in terms of teaching and also people showing me respect when I speak. And I think that you should be taking notes and making sure you don't miss any information. And of course, you're going to pay for this course, so it would be stupid for you to miss any type of information, right? But that strictness was ingrained in me when I carried this scar with me for the rest of my life. So when you come into my boot camp, you represent me after you graduate. And so when they say that, lawyers say when they go to law school, basically a law school takes their brain and reprograms it as to what's right and wrong. So they start looking at things differently. So that's what I'm going to do to you. There's a lot of information, and everything you've thought you knew about Wall Street and all the myths that you hear that stock market and trading is gambling and all this BS, most likely you got it from people that lost money in the markets. So as you know, most people lose money in the markets. The people who make money on a consistent basis are the fund managers. And even a lot of hedge funds, they go out of business when they take too much risk. So everything boils down to risk. And that's why this is the first course the first module I'm going to talk about primarily risk management. And risk is everything, because I don't consider myself a trader. I did when I was starting out. I was telling everybody I'm a day trader. But as I got older, I realized I'm a risk manager. I manage risk, and the profits take care of themselves, right? So again, my first course, okay, the position trading, that's, I say you crawl, you walk, you jog, you run, and then you sprint, right? So my swing trading course is the crawl, and then the day trading you'll walk, and the options you'll jog, and the hedging you'll run, and then once you get the portfolio management down, that's when you'll sprint. So, and that's how I envisioned these courses when I was creating them, as to slowly turn up the heat on you as you get better and better. So under this module, we can talk about technical and fundamental analysis, the risk-reward diagonal line, position trading versus day trading, martingale strategy. We can talk about the animal farm, which is the bulls and the bears, the systematic versus unsystematic risks. We can understand the beta of how that works. Hardly any of the traders look at beta when they're trading, and that baffles me. Beta is everything to me. And you're going to see how beta defines correlation and volatility. We're going to look at market cap and the importance of that, the outstanding shares versus float. We're going to look at growth stocks versus dividend stocks. And then you're going to get a little intro of my value score that I created. So I have my own value score that I created with my own components that derives from financial analysis. And then I'm going to end the course with margin risk, which is if you're a swing trader, you hold stocks overnight, your margin risk should be utmost priority, because last thing you want to do is get a margin call. So I'm a very meticulous individual, and I calculate everything. I'm addicted to numbers. I've always been since I was a little kid. So let's say when people say you have a life expectancy of 80 years, that's not necessarily true. I actually calculate it to be 62 years if you live a full life. Okay, so let's look at 80 years. You take 80 years, you multiply it by 365, and you multiply it by 1440 minutes a day. That gives you 42 million minutes, right? So 42 million minutes is 80 years. But you have a lot of things that you got to do. You have to give a lot of your minutes to work. So let's say you have to work 50 years. So that's 6 million minutes right there. And the calculation is 480 minutes times 253 work days a year times 50 years. What is that? That's 6 million minutes just you spend on work. And then the commuting is another 759,000 minutes, let's say, if you spend an hour a day for 50 years. And then the chores, if you have, the more kids you have, the more chores you have. And I'm laughing because I don't have any kids and I don't plan to have any kids, because time is very precious. So then that's, chores, I calculated for 80 years you can have chores. Hygiene, showering and all that. 876,000 minutes. And then so your true life minutes after you deduct all that is 32.5 million minutes. Now, how would you backtrack 32.5 million minutes, which is what's left of free time for you to enjoy? How many years is that? So you backtrack, you divide that by 1440 minutes a day, which is each day has 1440 minutes. And then you divide that by 365 and you get 62 years. So your true life is 62 years. That's if you don't get hit by a bus, and nothing tragic happens to you. So that's your full life, 62 years. So the key takeaway is don't have any kids if you want to have a lot of time to yourself, right? So for those of you who had kids, things are much tougher for you if you're not a millionaire, right? Have you heard of the expression, time is money? Well, my whole life I thought of time as money, but it's actually the opposite. Money is time. Okay, so that's how I think. When people say I'm a millionaire, I'm thinking you're not a millionaire, you just don't have to work 15 years. If you're single and you don't have any kids and a lot of expenses, then $1 million is about 15 years of not doing anything in Los Angeles, let's say. Okay, if you move to Philippines, then yeah, you might be retired with $1 million. But let's say in American standards, you're not impressing me anymore when you say you're a millionaire. When you say you're a multimillionaire, that's a whole different deal. But a millionaire, millionaire can go away real quick, especially with the inflation, how and low wages. So $1 million is not what it used to be. Okay, back in '60s, $1 million was a lot, but not anymore. So from now on, when you hear people say time is money, no, money is time. Okay, don't go and buy a brand new Mercedes when you have a little bit more money, or as a real estate agent you closed a couple of deals. No, just think of that money. You take that money, you convert it into time. Okay, how many more years can I do nothing? So once you have $3 million, that means you don't have to do anything for the rest of your life. If you don't have any kids and you don't have a lot of expenses and you're going to live a frugal life. Okay, so it's all about relativity. So who are my courses for? Okay, my courses for, number one and foremost, as I said, a stock trader who's losing money by listening to Instagram gurus under age 30 with no consistent profitability. These guys show explosive gains of 4,000%. But for some reason, can't repeat the process due to fear of becoming a billionaire. And since a lot of people don't understand basic math, if somebody says, I'm consistently profitable and I just made 4,000%, I'm like, if you could make 4,000% 3 times, you would become a billionaire. Do you understand that? None of these guys are billionaires. None of these guys are going to be billionaires in 3 to 5 years, and they're all going to disappear. I've seen so many people come and go in the last 15 years. So I'm going to show you something. I'm going to show you how to calculate on Excel. Okay, here. You open an Excel. If somebody says, I turned $50,000 into a couple of millions, okay, in 45 days, okay? And so all these guys claim like 1,000% up to like 10,000%. Like, you're ridiculous. Who are you lying? So anyway, look, you press the equal sign. Let me zoom in a little bit. Hold on one second. Sorry. Okay. So you go equal sign. You type FV, future value, tab, open parentheses. So, I don't know, what's the rate you want to put? 4,000%, let's say. Okay, let's say this Generation Z Instagram guru said he made 4,000%. I always mess with the Gen Z. I don't know why I do. But I'm a millennial myself, guys. I'm 37 years old. I'm a millennial, so I can't talk too much crap about them. So 4,000%, and then the second one, you press comma right after comma, and then NPER is a number of periods, right? So let's say he's going to make 4,000% 3 times, which is in 3 years, once a year. So he's going to make 4,000% 3 times on $50,000. Okay, so we're going to put 3, we're going to put comma. For payments, PMT, you put 0. We're not doing payments. And then the present value of his money, you're going to do negative 50,000. Okay? And then the type, don't worry about it. It's end of the period or beginning of the period. We're going to say 0. Right? Don't worry about that. So look, he's going to make 4,000% on 50 Gs 3 times in a row. Compounded 3 times. He would have $3.4 billion. So none of these idiots are actually, oh, I shouldn't say idiots. None of these imposters are saying what they mean. Okay, so don't pay attention to them. So let's see. So now you know how to use Excel a little bit. And then my next group of people is baby boomers. Baby boomers, guys, they're retiring at an astronomical pace, and they need to retire. They need to be able to manage their money, right? So my courses are going to help them call their financial advisor and say, I don't need you anymore because I finished stocks boot camp. So, and you're going to make so much more money than your financial advisor would. And hopefully, you know, you finish all the classes and everything makes sense to you. And even if you're a millennial or Gen Z, you can take control of your own money. There's all kinds of apps from Robinhood to TD Ameritrade. You can be on your phone. You don't have any more excuse that, oh yeah, I can't, I don't have the time for it. No, my courses are designed for people who have full-time jobs. You can do this. All you need is like 30 minutes to an hour a day, if that. I used to trade from my bathroom stall when I had a job. Do you understand that? So don't give me the BS of that you don't have time. So instead of suffering from a recession, guys, you can start short selling, you can buy option puts, and you can profit from a recession going forward. Okay? So that's the main reason why people should take my course. Number 3, the chartered financial analyst. Let's talk about the CFAs who want to strengthen their portfolio management skills. My course is for you. Of course, you already know everything, but why do you need a company to hire you? Why can't you make money yourself in the markets if you finish this grueling 4-year course? Like, you get the designation and you still can't find a job, then I feel very sad for you. Okay, because you spent about $10,000 to get that CFA designation. And it's amazing to me how many people I talk to on LinkedIn as a CFA. CFA, you're like, you know everything about finance and you still can't find a job. Or worse, you can't even make money on a consistent basis in the markets. That's pathetic. And CFA, a lot of their stuff is now ethics. Besides the level 1 and some level 2, it's just they want you to know your stuff in terms of ethics and portfolio management. So again, some people, I don't want to talk about this, but it fascinates me how brainwashed I was in school, because up to a point where I finished it, I was still thinking that I'm just going to go out there and move up the corporate ladder. Okay, and then when I started moving up the corporate ladder, I realized that it's all based on whether my manager or my superior is going to like me or not. So if they do, or if I screw up a few times, I'm done. So, if they like me, then I'll move up. And then even if I move up, the company might get rid of me, as I got laid off so many times, and then find somebody cheaper. So basically, it boils down to 2 things. Either you are a workhorse for a company, or you own everything. You're the actual boss. You're the owner. So it took me a while to realize after I finished school that, holy crap, school education system just teaches you to be a follower. It teaches you to be a corporate slave. So unless you're a doctor or engineer and you love your job, that's different. But for the most part, most people are basically the slaves of shareholders. And who's the shareholder? Sometimes the actual workers themselves, because their 401ks are tied to those companies that they own. So you own yourself. You know what I mean? So anyway, we'll get back to that later. The last one is anyone who was born without $1 million, including myself. Okay, I came to this country as an immigrant. I didn't have nothing. So, whose parents constantly tried to teach them the value of $1 while masking their own mistake of having a child without truly being able to afford one. Okay, so all of your parents, if they're not millionaires, at some point as you got older, they slowly turn up the heat on you. They taught you the value of $1. They told you to go rake the leaves outside or wash the car, this, that, because they were broke themselves. And if they were not broke, they didn't have enough for you to do nothing. Eventually, they wanted you to get a job and start contributing because they wanted to mask their own, not all of them, again, of course, but for the most part, at least my parents and a lot of the Armenian parents I know, they try to show up this aura of them being successful when they're in actuality working paycheck to paycheck. So a lot of it is BS, guys, okay? So even your parents were hypocrites and you are a hypocrite. And I'm a very straight shooter in a lot of ways where numbers don't lie, okay? So I grew up in such a poor environment where people with families would actually hide the best candy and the best refreshments and all this, and they would hold it for whenever they would have guests, and they would take it out when there was a special occasion. Okay, so people were poor at that level, but they were trying to act like they have something, because when the guests would come, they would want to show that they have money, but in actuality they were all broke. Okay, so when I grew up and I saw that, I was like, this is pathetic to me. I never want to be in that situation ever in my life. Again, people in America don't have that problem, but because the standard of living is much higher here. But a lot of third world countries, they still do that. Anyway, enough blabbering about stuff that don't matter. Let's get down to business. Guys, everything in life, including stocks, securities, there's a risk and reward line. Okay, this risk and reward line is diagonal. Okay, so you have the more risk you take in life or in stocks or in any securities, then the more you have to get compensated for it. Okay, my courses here, the first course is going to focus on blue chip companies. Okay, and then, they don't make as much as small caps. They don't make as much as emerging market speculative stocks. But the blue chips are much considered safe investments, right? So if you want to increase your yield on blue chip stocks, then you have to buy the options, right? If you buy the options on blue chip stocks, then you'll have the same yield than if you have taken it on a micro cap or a small cap stock. So why would you want to take a lot of risk on a company that hedge funds don't want to accumulate when you can find the same yield in a blue chip option? And that's all I'm trying to tell people, but nobody wants to listen. So technical analysis works all the time except when it doesn't. When I read this in Tony Turner's book, I was like, so what's the point of doing it? Really, I mean, technical analysis is might as well just roll the dice. Sometimes it works, sometimes it doesn't. In this picture, you see technical analysis, the cup and handle. You see that cup and the handle. It failed. It failed miserably. But I'm sure a lot of people bet a lot of money upon that right part of the handle, thinking that it's going to go higher, which it didn't. It actually collapsed. So Tony Turner, she's an educator, but I don't think she's a money manager. But there's a lot of good information in her book. Short-term profits trading. Again, what she said, it resonated with me many, many years. Technical analysis works all the time, except when it doesn't. Now, day trading technical patterns fail way more often than swing trading patterns. Okay, so when you have a major trading desk like UBS or Citi, and they want to unload a large order, let's say 50 million shares of Apple in one day, they call these iceberg orders. They're not going to tell you that they're going to unload 50 million shares of Apple because if they did, people would panic and the stock would tank, right? So they have to layer in the smaller parts and they have to mask the quantity of that order. And this is the main reason why day trading is very speculative, the main reason why day trading is so risky. Okay, and this is when they say, oh, it's manipulated, market makers are manipulated. This is the reason. Because when large funds, they want to dump their shares, they have to cut them into smaller pieces so that you don't realize somebody's unloading a lot of shares. So their sheer power is so powerful that it's going to erase your technical analysis chart patterns like an Etch-a-Sketch, making day trades less successful than swing trades in terms of consistency. In college, I was Bloomberg Platform certified. In Bloomberg Platform, this is a snapshot of a Bloomberg Platform level 2 order, right? So you got the size column. See on the size, it'll say, like 1, and then here you'll see a 5, and then here like a 6. I'm sorry, here it'll say like a 5 and a 10. So each of these, you have to add 2 more zeros. So let's say a 1 is 100 share transaction. So 5 is a 500 share transaction. So someone's waiting to sell, let's say, 500 shares at $439.10, and someone's waiting to sell at $439.22, and everybody just lines up, right? So these iceberg orders are layered. Maybe the 10 and the 5 and the 4 here could be the same fund, same company trying to unload their shares. So they'll layer it like this, and you won't know that a major sell-off is happening until it's too late. Some people realize it, and then they jump out and they cut their losses. But a lot of times the market makers will do it on purpose, where they manipulate and they'll take the trade against you because they see the volume and the order flow of all the orders that come in and out. So they know exactly how to bet against you. So the game is kind of rigged if you think about it. So moving on. So technical analysis added a lot of broker transaction and a lot of liquidity. So because of this, I look at it as it was the most successful garbage that was introduced to the poor by the wealthy on Wall Street. Because guys, Warren Buffett doesn't care about technical analysis. Jim Cramer, I mean, he talks about it, but he doesn't care. He cares about annual reports. Warren Buffett doesn't even care about quarterly reports. He just reads annual reports. He has a long-term horizon of 5-10 years, right? So he doesn't care what happens from one quarter to the next earnings. He doesn't care. Okay, so technical analysis allows traders to try to find the direction and profit between those time periods of 3 months. So they can try to get in and out, and they try to find patterns to try to profit from those patterns. So here's the best way I can prove to you that technical analysis is garbage. Okay, if I decided to sell 10% of Facebook in the shower this morning, hypothetically speaking, okay, I'm taking a shower, I'm like, you know what, I'm going to sell most of my company today, or a good percentage of my company today. I haven't even told this to my wife, right? So how is your technical analysis pattern going to show what I'm thinking? Right? So if you're a trader, you might be in a, let's say double top, okay? You're at a double top, and a double top is a pattern where you're about to short sell. So you want the stock to fall. So you're in a double top pattern, you think the stock's going to go down, okay? And here I come, and instead of selling my stake, I decided to buy another 5%. So I just erased your double top pattern because I changed my mind that second, and everything went the opposite way now. So what are you going to do as a day trader? You're going to cut your losses, and you better lose your ego fast and admit that you were wrong and take the opposite side of the trade. So as a day trader, you constantly have these, once in a while, you're going to step on these landmines, which is, they call them, market maker manipulations, right? So the point I'm driving at is technical analysis cannot forecast anything. It just merely tells you what the stock could do based on historical patterns, which have already occurred, okay? So based on volume and the historical patterns, you still can't accurately predict the future, because the stock market volume and the buys and the sell transactions is based on the big boys, the hedge funds and financial institutions, making these large orders, and they're the ones who move the markets. Anybody who knows inside information, that's illegal. You cannot trade on inside information if you know something. So for those of you who are still confused what technical analysis is, what fundamental analysis, if this is the best analogy I can give you. Okay, so technical analysis, think of it like this. Let's say you stand outside of Burger King and you watch people go in and out, and then you calculate how long it took him to go in and out, and you count how many people went in, and then you plot all that data, and you make assumptions whether Burger King is going to survive as a company or not. Okay, Whereas fundamental analysis, financial analysis, is going inside of the building and asking the manager how much did they spend on the beef and the cheese, and do they own the building or do they lease it? And then after analyzing every single detail by asking questions, including all debt and legal fees for sexual harassment claim after the manager groped one of the employees by the fryer. I had to make that joke. Then you make your decision seeing whether any income is left after all the expenses. So which one is more accurate, guys? Do you want to go inside and actually get the numbers, get the details? Meaning, do you want to do financial analysis and see how much debt the company has, what's their income, and calculate everything right there, black and white? Or do you have more accuracy with the technical analysis pattern? You just stand outside and you look at customers go in and out, and you make assumptions whether Burger King is going to go bankrupt or not. How do you know if the people who went into the Burger King didn't go and use the bathroom and come out? Maybe they didn't buy anything. Do you understand? Do you catch my drift? This is the reason why technical analysis is full of assumptions. So, like Tony Turner said, it works all the time except when it doesn't. So a lot of times it's just 50-50 shot. Okay? So it kind of gives you an idea on a longer term. When you look at yearly trends and you look at longer term trends, it makes sense because, of course, the psychology of people, it works the same way. But you cannot use technical analysis to predict the future accurately. Look at what's happening in the last couple of weeks. Patterns are failing all the time, and now Trump's tweets move the markets. It creates volatility. The news is so uniform. If one news source reports a positive news, then everybody else just follows suit. And if one news outlet reports something negative, and then everybody has to jump on the bandwagon and report something negative because it's all about ratings. So now news events are moving the markets, which have nothing to do with valuations. Are we going to have China deal? No, we're not going to have China deal. Are we going to do this or we're not going to? It's just, it has nothing to do with finance. So over the long term, when you're looking for consistency, valuation and financial analysis trumps everything. So look, when I see all these Facebook comments and all these people who think they know everything, so when they first start out as day traders, this is the chart that they think. Okay, they look at the yield that day trading is going to bring you. So they say, okay, day trading is going to make me 100% a year, whatever. So they're looking at the yield and they get excited. So they say, okay, I want to learn day trading. And then, swing trading makes less money, of course, and investing makes even less percentage gain each year, right? So new traders are often lured by higher percentage profits. But what the actuality is, do you know how the chart looks? This is how it looks. In actuality, in terms of consistency of profitable trades, day trading actually ranks the lowest. So if you multiply the consistency of your profitable trades and you multiply it to the gain, then the picture is going to actually show a completely opposite picture. Wait, that didn't make sense. So then, swing trading actually looks much better, and investing in terms of consistently being profitable is going to trump highest. And of course, because all these financial institutions, all the 401k plans, all these investments that you make, they have to deliver, they have to be consistently profitable, because these are professional money managers that have to make sure that you make money on a consistent basis. So the day trading, even though you're trying to make more gains, you're going to have this back and forth taking losses. So you subtract all your losses and then you take money to pay the bills, and there's nothing left at the bottom. So in terms of consistency of making day trades, you're definitely going to rank the lowest. So that's why I teach people to start off with swing trading, which is the foundation. You start off with swing trading, and then you use a small portion of your portfolio to day trade. And whatever profit you make from your swing trading, you can take that profit and use day trading, improve your day trading skill. So you're always playing with the house's money. Got it? So, again, I'm not bashing day trading. I used to be a high frequency trader. But day trading is like running through a field full of mines. Okay, you will get lucky here and there with a lot of home run supernova trades, but repeatedly you'll be taking giant steps backwards. Okay, and time is money, right? Money is time. So, if you took a loss, then there goes a couple of days of your income, right? You take different bet sizes, right? So you take different sizes each trade that you do. So you might be on a roll, right? You made 6 consecutively profitable trades. You made $200 here, 500 here, 300 here, and your confidence is building up, building up, building up. And then you take one heavy trade, and then that's the one that's going to go against you. It's going to set you back a couple of weeks or even a month. So my value swing trading course will help you diffuse the landmines and then cross the field safely. So it's going to take you longer, which means you're going to make less money, but you'll get there in one piece without blowing up your account. And that's the whole idea of this course is I want you to keep trading. Just like Jim Cramer says, I want you to stay in the game. The way you stay in the game is you take less risk until you get better. So, from now on, when you hear somebody says, I'm a professional trader, blah, 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 you need to understand what a professional trader is. All these gurus out there, they have tons of monitors, just like this picture over here. Everybody has a ton of monitors, and they're trying to, when I was young, right, when I was in my early 20s, I would look at people have a ton of monitors, and I would get fascinated. I'm like, oh, this guy is successful. It's actually the opposite. All these people are trying to show you that they're smart by having a bunch of monitors as their profile picture. But that's the number one way you can tell me that you don't know what the hell you're doing, okay? As a matter of fact, if you have more than 4 monitors, after a while you start to get a headache and your focus is not right. I'm usually on a couple of monitors and I'm focused on 1 or 2 stocks that I'm trading, right? If I'm a day trader, I'm focused. But if you're looking everywhere, you want to have eyes on every single stock, you're going to actually do way worse. So that's one few ways that I know that when people have a ton of monitors, I'm like, I don't know. That's kind of a red flag for me. So what is a professional trader? Your trading income equals your realized gains, you subtract your realized losses, you take out capital gains taxes based on your bracket of your income, you minus commissions, then you take out money to draw down to pay bills, and that's your trading income. So do you know how hard this is, guys? Do you know how hard it was for me to maintain a $25,000 account when my girlfriend, I lost 2 relationships over the fact that I was trying to be a professional trader. I couldn't take my girlfriend to a vacation and I was living a frugal life just so that my account wouldn't go below 25,000. Okay, so don't think professional trader definition is, it comes easy. It's not at all. So I can totally detect people's BS. My BS meter goes off the charts when people say I'm a professional trader. I'm like, no, you have a full-time job, you have a side income of some sort. Okay, so one question you want to ask yourself is, what is your monthly expenses? Okay, $2,000 a month, $4,000 a month, $6,000 a month. Are you living in San Francisco or Tucson, Arizona? How many kids do you have? All that is, matters on your disposable income, right? Your disposable income is everything. So if you think you can survive as a full-time trader without having stress, think again, okay? You're constantly thinking of not taking a lot of risks so you won't lose a lot so that you can take out $2,000 a month to pay your bills. It's not easy, okay? But if you want to move to Philippines and live a single life frugally with a $50,000 account and make 30% profit a year, and your monthly expenses, let's say $1,000, and you're making $15,000 a year, yeah, you can make it work. But in living in LA, we know how hard it is. So be careful of those people who say that they're professional traders. Okay, so position trading, which is swing trading, versus day trading. Is it for you if you're just starting out? Okay, so for a majority of you, you have full-time jobs, you're going in and out of meetings, you don't have time, you don't have the time to watch the market constantly, then position value trading is the perfect thing to start with. Okay, if you're a day trader, you have to be in front of the computer for a while, at least a couple hours at the first open of the market. There's volatile hours, let's say the lunchtime in New York, and then the last 30 minutes of the close. But the majority of the action for a day trader happens the first hour, okay? And then the algos will eat you alive, so you shouldn't trade between those hours. So day trading is for unique persons that can stomach more risk and have a stronger common sense, and they have the ability to control their fear and greed. Okay, because these are the two emotions that are going to kick into gear as you're trading, especially if you're taking heavy risks. When I was doing, $80,000 to $100,000 position in Facebook or Apple, one little tick, costs a couple of $100 and goes up $1,000, gain or loss. So sometimes the feeling was so, so strong, like my heartbeat would slow down. My fingers would be numb from me just like biting my fingernails. Just, okay, what's going to happen? What's going to, one little tick here and there, it's major moves. So if you cannot stomach a lot of risk, then, day trading, it may not be for you. So also remember, since 2009, scalping is much harder than it used to be because of algos. If you haven't read the book Flash Boys by Michael Lewis, you definitely should read that before consider day trading. So realistically, maybe 5% of you will become professional full-time traders. They say 90% of the traders fail. It's more like 95% now since 2009. So when I started out, I was a high-frequency trader. I was a point-and-click high-frequency trader, which means I would scalp small pivot points on oversold and overbought conditions 40, 50 times a day. Okay, I will show you a separate video in my Lightspeed trading account. It was like 500 pages. So I would do a volume of $11, $12 million a year. Okay, and people thought I was crazy, but it was working. I was making $20, $30, $40 each time I would trade, but I would make 40, 50 trades a day. Okay, so not everybody used the same tactics that I did. Okay, most people, especially now, the way they trade is they'll make a few trades in the morning and that's it. They'll go heavy, they'll come out either a winner or a loser. Okay, but I used to trade all day. I would trade the entire day from beginning till the end. My eyes would be red and making 40, 50 trades a day. So my commissions were ridiculous. With Lightspeed trading, your commissions are pennies, but they would add up. But because I was doing volume, it was not a big deal. So again, I want to reiterate that my personal rule is to only day trade with profits that you made from swing trading. So aka playing with the house's money. This is the very rational and logical way to keep your yields consistent. Okay? So the main benefits of position trading is this. You don't have to cut your losses immediately, just like day trading. Averaging down is encouraged on the right companies. This is very important. On the right stocks, averaging down is encouraged. Hedging, whether it's with inverse relationship, securities, ETFs, options, hedging can minimize losses. For example, oil goes up, transportation goes down, right? Chevron goes up, FedEx goes down. Sometimes this perfect inverse relationship turns into semi-inverse relationship, just like gold and SPY, and you gotta be wary of that. but you can find hedging very lucrative in a lot of ways. So I have a whole separate course dedicated just for this, which is so fascinating. Some of the hedges that I've done before. There's delta neutral hedging option strategies that I used to execute, and I spent tens of thousands of dollars just on delta neutral strategies. So you're not susceptible to algo-based manipulation. You can capture dividends. You can get into a stock a day before the dividends are paid out and get out with dividends. There's class action lawsuit benefits. Each year I get a stack of class action lawsuit papers that I have to fill out, and sometimes they win the lawsuit and I get money from that. And then you're consistently, like I said, you're consistently more profitable than day trading. You better be, because it makes sense, right? I will teach you how to recover your losses where you're constantly profitable, at least most of the time. There's going to be times where you take losses, of course, but for the most part, you're going to realize most of your losses. The shortfalls is that there's overnight risk. Okay, something happens, geopolitical issues, a tension between, let's say, Russia or North Korea or whatever, God forbid, terrorist attack or anything like that can destroy you, right? So my friend's uncle lost a lot of money, lost like $500,000 on 9/11. So he panicked and he sold and he took a loss. So anything can happen. But when you're a day trader, you wake up every morning, you're 100% cash, you have nothing to worry about. So you wake up the next day and everything is great. You start fresh. But you miss the gap ups, overnight gap ups as a day trader. So then the second shortfall is it has lower returns than day trading because you're waiting for your stock to recover its losses and so forth, right? Okay, so how does my slingshot value swing trading methodology work? So forget about individual stocks like Chevron, Walmart. Let's think of the entire stock market, okay, SPY. So every major sell-off on SPY brings you closer to the next reversal that is due, right? Think of a slingshot. You stretch a slingshot. Okay, you stretch it more and more and more. The probabilities of it snapping increases, right? So the more it stretches, then the more powerful the next reversal is going to be. So if you're the entire stock market is selling off, it's like 1, 2, 3 days in a row that it's selling off, 3 days in a row that it's sold off. The fourth day, it's going to reverse. And the more it sells off, the more powerful that next reversal is going to come. And that's when you need to bet the heaviest. Okay, I just gave you the main secret recipe, guys. I mean, this is my main secret of my course. That's how I do. Position size is everything. So you bet heavy on the right companies, or if you don't want to do the right companies, the entire stock market, and you do statistical analysis and watch your position size, and you'll know exactly at what point you will recover your losses. So if you average down with the correct position sizes 2 times, 4 times, and you hedge accordingly, then when the reversal comes, that powerful initial force will slingshot you to a break-even point much sooner on your unrealized losses. So having said that, we're going to look into martingale strategy. If you don't know about martingale strategy, you should definitely learn about this. It's very basic. If you ever get a chance to do this, you can do this while playing blackjack in Vegas. And if you use martingale strategy on blackjack, most likely the pit boss will come to you and say, "Get the fuck out of my freaking..." They'll know exactly what you're doing. This is worse than counting cards. So martingale says this. Martingale says, there's no way you're going to lose 10 times in a row. If you do, then you're the most unluckiest person in the world. But let's say you play a $5 blackjack, right? You lost one hand, $5. The second hand, you bet 5, okay? You lost again. So now you lost a total of $10. So what's your third hand? How much do you have to bet on the third hand so you can recover all your losses. So you're gonna bet $10, right? So you lost again. Now you lost a total of $20. Now you're gonna double up, right? You bet another $20 so you can recover the previous losses, right? So then you go, you go to 40, 40 goes to 80, 80 goes to 160. So you keep doubling up until when you win once, and then that just brings you to break even immediately. So the bad part is you're gonna keep losing money, and you better have the bankroll to keep betting, right? But once you win once, you immediately broke even. You broke even, and now some people do the opposite. Some people do anti-martingale strategy, where every time they win, they double up. If they win that, they push that even higher. So some people use a combination of martingale strategy and anti-martingale strategy. Okay, so if you want to play conservatively, then you do use a martingale strategy, which means you lose and then you double your position or quadruple or what have you to cover all of your previous losses if you win once. Okay, so instead of having first hand, second hand, third hand, in the stock market, it's the first pivot point, second pivot point, third pivot point. So every time it has a nice little sell-off, and we have a major reversal with strong volume. That's considered, let's say, the second hand and third hand. Does that make sense? So now let's start with the animal farm. Okay, bulls and the bears. I'm sure you heard of it. So the bulls, aka longs. So going forward, I'm going to be saying longs. Okay, so if I say longs, that means I want the stock to go up. Okay, so bulls hit you with their horns, you fly up in the air, and that's why the name came, bulls in the paw. And then the bears, they hit you with their paws, they bring you down. Okay, so that's shorting. Short selling is bears. So the bulls, there is a bull on Wall Street. Why? Why is there a bull on Wall Street? Because the companies need to grow their earnings. So long term, companies should increase profits and the stock should go up, right? Technically. And notice my company logo is even a bull standing on a bear carcass. Okay, it's because even though I started off as a short seller, I'm still a short seller, but my high frequency days, I would short a lot of these companies that deserve to be short, right? So I would short small pivot points, and my nickname was Armenian Bear. Armenian Bear 69, that was my nickname. But as your portfolio grows, you're holding a certain percentage of your portfolio long term as an investment, because you also get tax break, right? The government forces you to hold your stocks long term over 1 year so you can get a better tax break. Versus if you sell something less than a year, so if you're a swing trader, day trader, then you got to pay capital gains tax. So the IRS and the government, it encourages you to hold stocks long term so that the company has room to breathe. The company has time to generate more profits for you. So I'd say 20-30% of daily volume is retail traders buying and selling. But the major moves up, the gap ups, happen when large pension funds, financial institutions, they bring real money into the table and they buy long term, right? And then the shorts are the bears. So again, when you hear the word shorts, short sellers going forward, that's the investors who want the stock to go down. So remember, the bears, they hit you with their paws, they bring you down. So the bear wants the stock to go down. Now, every professional trader would rather be a bear for two reasons, okay? And the mainstream, they don't want people to know this, but this is intuitive for a lot of people, and this is the reason why most active traders, they short sell, because one, fear sets in faster than greed, right? If you yell fire in a crowded room, everyone's going to panic, right? So when panic hits, the stock drops like that. So you can make 5-10% like this, and then it's going to take days and weeks for it to recover 5-10%. But here's the second part. The second part is when a stock drops 50%, it needs to rise 100% to get back to the same level to break even, right? So look at that. If $8 goes down to $4, that's a 50% drop. But for $4 to go back up to $8, that's a 100% gain. So not only it has to go up twice as much to get to the same level, but it's going to take forever because greed comes slow. Slow. Nobody wants to step up. When Ulta Cosmetics sold off recently after the earnings, it was flatlining for so many days. Then slowly investors started coming up, and then once you see other investors get greedy and you're like, damn, that's when you jump on the bandwagon. And that's the human psychology. If you look at a restaurant, if you see a restaurant has 1 or 2 people in there, you're like, screw this place. But if you see people outside line out the door, people are waiting an hour to get in, you're like, oh, I don't mind waiting in an hour. They must be good. That's when it's the same concept, guys. Either nobody cares about you or everybody wants you, right? That's how it is. So one tip, and in the courses, you're going to have these tips, you're going to have rules. You have to remember all of this because it's going to be on the exam. So one tip is there's always a list of stocks that are not shortable due to their lack of liquidity. Or if, let's say, a new IPO came out, they don't let it be shorted for a little bit. They want to let the IPO breathe before short sellers attack the company. Okay, so sometimes IPOs are not shortable, and then based on liquidity and market size or a specific reason, you might not be able to short sell. Okay, so that's why I keep a couple of accounts open, because companies like Short Trader, which I'll get to that. By the way, it's in my broker review. You should watch my broker review video. So some brokers, they have a larger short selling list, and that's why a lot of day traders gravitate to those brokers. But those brokers have their own shortcomings, and if you should watch my broker review video for me to give you the most updated list of what I think of each broker. Now, in the indices, when you watch CNBC, you're going to listen to Dow Jones, NASDAQ, and S&P 500. These are the top 3. Then there's Russell 2000, Wilshire, and so forth. But the main 3 you're going to hear is Dow Jones, S&P 500, and NASDAQ. And that's all you're going to hear, okay, when you turn on TV. So, few very important things you need to learn about what each index does. Okay, so the Dow Jones is the largest, 30 of the largest companies in US. Okay, they employ about 5% of the US population with a cumulative market cap of $6.5 trillion. So, one very important part, you need to learn this, is in Dow Jones, stocks that have a higher share price are given greater weight in the index. Okay? But this is not a great representation of the health of the US economy because it's only 30 companies. Okay? So if you look at a high price stock like Boeing, at this time of I wrote this, it was $354 a share. McDonald's was $205 a share. They have more impact on the final calculated value of Dow because their share price is high. So 354 is high, 205 is high. Okay, so the price counts. The higher the price, that's what counts here. So the calculation is, if you care to know, it's sum of the price of one share of stock for all of the components, all 30 of them, divided by the divisor. And then they calculate the divisor. The divisor right now is 0.14. Okay, so you take the sum of average of the 30 company prices and then you divide it by the Dow divisor, which is 0.14. And that's how the Dow Jones is calculated. That's all you got to know. S&P 500, now look at this. S&P 500 has 500 large U.S. companies. Not the largest, just 500 large U.S. companies with a total value of roughly 25 trillion. Now, stocks like Facebook, And Honeywell, 496 billion market cap, 125 billion market cap, have more weight on the index. Now, S&P 500 is a market cap weighted index. So S&P 500 gives more weight to the companies that have a larger size. Not a larger stock price like Dow, but the ones that have larger size. And the market cap, which is aka size, it changes every day. Just like the price changes every day. But this is why I like S&P 500, and I trade mostly S&P 500 versus DIA, which is Dow Jones, is because I like the fact that it puts weight on the size of the company, not the price. I can care less about the price, to be honest. But, newcomers, they think, oh, Amazon is $1,800 a share. That means it's expensive. Stock price has nothing to do whether a company is expensive or cheap. That's a whole different question you're asking. Okay? So the market cap is equals outstanding shares times stock price. Stock price changes every day. Outstanding shares stays constant. Okay? So the market cap is going to change because the stock price is going to change. But the outstanding shares of how many pieces that one company is divided into, that's going to stay constant. Okay, so don't confuse outstanding shares with float or enterprise value, which we're going to discuss later. So most investors, including myself, we see S&P 500 as a better representation of U.S. economy due to its diverse broad of sectors and industries, right, versus Dow's 30, because 500 companies, that's more companies in different sectors. So it gives me a more accurate picture of the U.S. economy than Dow, which is only 30 companies. Make sense? I had a friend who would say, make sense, after everything he would say. He would say, make sense. And I think I learned it from him, and I can't get it out now. So the last one is NASDAQ. So NASDAQ stands for National Association of Securities Dealers Automated Quotations. This was created back in the 70s as an index of more than 3,000 stocks listed that includes the world's technology and biotech giants such as Apple. I'm sorry, not 70s, 90s, I think. That's a good question. I need to look it up. So it houses mostly technology stocks, okay? From Apple, Google, Microsoft, Oracle, Amazon, a bunch of others. So one thing you should know about NASDAQ is if a stock has 4 letters, then they belong in NASDAQ. Any stock you can think of has 4 letters, it belongs in NASDAQ. So when you see NASDAQ composite, the average move down, then most likely your stock's going to get affected, because if your stock is housed under NASDAQ, then it's going to affect. And again, with all the 3 indexes, if you have a stock that's 3 letters and it's under NYSE, then, if something happens to S&P 500 or the Dow, then your stock is going to, if your stock is under Dow, then it's going to get affected. Okay, so again, keep in mind that the market cap weighted stocks is under S&P 500, and the price-based importance is under Dow. Okay, so that's all you got to know about this. And NASDAQ was indexed in a global electronic marketplace. That's the only index that's also electronic marketplace and an index. Okay, and this was the world's first electronic exchange. It operates in 25 markets. It has one clearinghouse and has 5 central security depositories in US and Europe. Okay, so who are the key market players? The key market players are financial institutions, pension funds, insurance companies, hedge funds, proprietary trading firms, sovereign wealth funds, and retail traders, which on some stocks it composes like 30-40% of daily average volume, and it's increasing. Back in the day, nobody cared about day trading, but with the technological advancement and the internet, lower broker commissions, and now all these brokers are now making their commissions free. Everybody's getting into the stock market. So right now we're having this crazy boom and crazy momentum of new people getting into the markets, which is amazing. Okay, now, one very important thing that I want to get across is you're not a trader, you're a risk manager, okay? Newcomers, novices care about how much money can I make. When you become a professional, you care about what's the worst I can lose. Okay, so every day when I go to sleep, I think in my head, okay, if tomorrow I wake up and SPY drops 3%, what's the loss I'm going to have? What's the unrealized loss I'm going to have based on the positions that I have open? Okay, so I get used to the norm. Okay, I get used to the norm. Let's say $2,000-3,000 move on the overnight risk is fine, right? But a large hedge fund, millions of dollars of daily volatility is the norm for them. It's crazy. So it's all relative. You have to get used to the companies you're trading, and your job is to manage risk. Okay? Your job is to manage risk. That's it. You always have to know the maximum loss and the worst case scenario of every trade you make before actuality occurs. Period. You manage your losses and your profits will take care of themselves. I promise you. It's a great feeling when you have an unrealized gain and you're just watching it get higher and higher. And then you set a trailing stop. You're like, okay, I'm good to go. I can cash out. When should? And the next question is, when should I sell? Now, that's a great question to have when you have an unrealized gain that's just sitting there and you don't care about cashing out. Okay? As a day trader, all you care about is cashing out, cashing out, cashing out. But when you have a portfolio, you're sitting on this large gain, you're like, all right, maybe it's time now. I can take a little bit of a profit. So again, you manage your risk, you manage your losses, and that's all you got to do. That's it. So again, this concept drastically differs from swing trading to day trading. In swing trading, you can recoup your losses by hedging and averaging down your cost basis. In day trading, oftentimes averaging down could be disastrous. So taking an immediate loss is usually the norm. Alright guys, I'm going to stop this video because my voice is getting coarse, so I'm going to take a quick break, then I'll continue.